Have you ever noticed how the people who got rich from investing all seem to have one thing in common? They bought when everyone else was selling. They invested when the market was crashing. When everyone else was panicking, they were calmly putting money in. Warren Buffett did it in 2008. The richest investors did it during the dot-com crash. The legendary investors did it during every major downturn in history. But here's what nobody tells you. It's not because they're braver than you. It's not because they're smarter. It's not even because they have more money to risk. They understand something about human psychology and market mechanics that most people completely miss. Here at Simple Money, we've studied every major market crash over the past 100 years, and what we found is absolutely fascinating. The crashes that feel the scariest, those are often the moments that create the most wealth. Today, I'm going to show you exactly why market crashes are actually wealth transfer events. I'm going to explain the psychology that keeps most people on the sidelines. And I'm going to reveal why understanding this might be the most valuable investment lesson you ever learn. Because here's the uncomfortable truth. Market crashes don't destroy wealth. They just move it from people who panic to people who stay calm. Here's what's really happening during a market crash. And this is going to sound backwards at first. When the stock market drops 30%, most people think that means 30% of the wealth just disappeared, evaporated, gone forever. But that's not what happened at all. The companies are still there, the buildings are still there, the employees are still showing up to work, the products are still being sold, the services are still being delivered. What changed? Just the price. Just what people are willing to pay today for a piece of those companies. Think about it like this. Imagine you own a rental property. Great property, good neighborhood, reliable tenant paying $1,500 a month. You bought it for $200,000. Then the real estate market crashes. Suddenly, similar properties are selling for $140,000. Your property just lost 30% of its value on paper. But here's the question. Did your rental income change? Nope. Still getting $1,500 a month. Did your property disappear? Nope. Still there. Did your tenant leave? Nope. Still paying rent. The only thing that changed is what a panicked buyer would pay for it today. The actual value, the actual cash flow, the actual asset, completely unchanged. This is what happens in a stock market crash. The underlying businesses often keep functioning, keep generating revenue, keep serving customers, but the price people will pay drops dramatically. Why? Because humans are emotional creatures, and when everyone is scared, they sell. When everyone is selling, prices drop. When prices drop, more people get scared. It's a cycle that feeds on itself. This creates an absolutely bizarre situation. The exact same company generating the exact same profits suddenly costs 30 to 50% less just because people are panicking. It's like your favorite store putting everything on sale because customers are scared to come in. The products haven't changed, the quality hasn't changed, just the price. But here's where it gets interesting. Most people see that sale and run away. They see the low prices and think something must be terribly wrong. Meanwhile, a small group of people sees those same low prices and backs up the truck. Same situation, completely opposite reactions, and completely different long-term results. So let me show you exactly how wealth gets created during crashes. Starting with what I call the discount window. This is the most obvious benefit, but most people still don't get it. When markets crash, you're buying assets at a massive discount. Let's use real numbers from real crashes. During the 2008 financial crisis, the S&P 500 dropped from about 1,500 points to 700 points. That's a 53% drop. If you invested $10,000 at the bottom in March 2009, that investment would be worth about $60,000 today. That's a 6 times return in 15 years. But here's what makes this really powerful. It's not just that you made money, it's that you made money way faster than normal. In a normal market, the S&P 500 returns about 10% per year on average. To turn 10,000 into 60,000 at 10% per year would take about 19 years. But by buying during the crash, you compressed 19 years of returns into 15 years. You accelerated your wealth building by decades just by buying when things were on sale. Now, I know what you're thinking, but what if it keeps dropping? What if I buy and then it crashes more? Here's the thing. Over a long enough timeline, the market has always recovered. Always. Every single crash in history has eventually been followed by new all-time highs. The Great Depression, the market recovered. The 1987 crash recovered. The dot-com bubble recovered. The 2008 financial crisis recovered. The 2020 COVID crash recovered in record time. If you're investing money you won't need for 5 to 10 years, the question isn't if the market will recover, it's when. And that when doesn't matter if you're patient. But here's what most people do instead. They buy when markets are expensive because everyone feels optimistic. Then when markets crash and everything goes on sale, they sell in panic. They're literally buying high and selling low, the exact opposite of how you build wealth. The discount window during crashes is your opportunity to reverse that pattern, to buy low while everyone else is panicking, to accumulate assets at prices you'll never see again once the recovery starts. The second massive advantage is what I call the compounding accelerator. This is where the real magic happens, and most people completely miss this. When you invest during a crash, you're not just buying assets cheap, you're buying future compound growth at a massive discount. Let me explain with a concrete example. Let's say you're investing $1,000 a month into an index fund. Normal market conditions, the fund costs $100 per share. Your $1,000 buys 10 shares. Now the market crashes 50%. Same fund now costs $50 per share. Your $1,000 now buys 20 shares. You're getting twice as many shares for the same money. That's the obvious part. But here's what people miss. Those extra 10 shares you got during the crash, they're going to compound for decades. They're going to grow with every market recovery. They're going to split when the company does well. They're going to pay dividends that get reinvested. 20 years from now, those extra shares you accumulated during the crash might represent 30 to 40% of your total portfolio value. You didn't invest more money. You just invested the same money at better prices, and that difference compounds into massive wealth over time. Think about it this way. Two people, both investing $1,000 a month for 30 years, same discipline, same consistency. Person 1 invests straight through, including during crashes. Person 2 gets scared during crashes and stops investing until things feel safe again. Over 30 years, with a couple major crashes, person 1 might end up with 50 to 70% more wealth. Same monthly investment. The only difference, person 1 kept buying during the crashes. This is the compounding accelerator. You're not just buying stocks on sale, you're buying decades of future growth on sale. And the earlier in your investing journey you experience a crash, the more powerful this effect becomes. A crash in your 20s or 30s, that's actually a gift. Those cheap shares have decades to compound. A crash in your 60s when you're about to retire, that's more problematic because you don't have time to recover. But that's a timing issue, not a fundamental issue with the strategy. The third reason crashes create wealth is something I call the transfer mechanism. This is the uncomfortable part that nobody really wants to talk about, but it's absolutely crucial to understand. During a market crash, wealth doesn't disappear. It transfers from impatient people to patient people, from emotional people to disciplined people, from sellers to buyers. Here's what actually happens. When markets crash, scared investors sell their shares. They're willing to accept much lower prices just to get out, to feel safe, to stop the pain of watching their portfolio drop. Who are they selling to? Somebody has to buy those shares, and that somebody is the calm investor who recognizes the opportunity. Every transaction has two sides, a seller and a buyer. During a crash, The seller is accepting a massive loss. The buyer is getting a massive discount. Fast forward 5 or 10 years, the market has recovered and hit new highs. The person who sold during the crash locked in their losses. They never get that money back. The person who bought during the crash, their investment might have doubled or tripled. The money didn't vanish, it just changed hands. It transferred from the person who panicked to the person who stayed rational. This is how every wealthy investor built their fortune. Not by being lucky, not by having secret information, by being willing to buy when everyone else was selling. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a cute quote, that's literally the mechanism of wealth transfer. When everyone is greedy, prices are high. You're paying premium prices. When everyone is fearful, prices are low. You're getting discounts. The people who get rich in the market aren't the ones who avoid crashes, they're the ones who embrace crashes as opportunities. And here's what makes this particularly powerful. The wealth transfer isn't random, it's not luck, it's a predictable psychological pattern that repeats every single market cycle. Fear creates selling, selling creates low prices create opportunity, opportunity creates wealth. For those who stay rational, the fourth advantage is what I call the psychology bypass. This might be the most important one of all, because understanding this can help you actually take action during a crash. Here's the thing about market crashes. They feel different than they look in hindsight. When you're living through a crash, it feels like the end of the world. The news is scary. Everyone is panicking. Your portfolio is dropping every single day. Your brain is screaming at you to do something, to sell, to protect what's left, to stop the bleeding. But here's what your brain doesn't understand. This feeling, this panic, this fear, it's exactly the signal that you should be buying. Think about it. When does the market offer the best prices? When everyone is the most scared. When does everyone feel the most scared? During crashes. So the worse you feel about the market, the better the buying opportunity probably is. Your emotional pain is inversely correlated with investment opportunity. This sounds insane, I know. Every instinct in your body is telling you the opposite, but the data is absolutely clear on this. The best buying opportunities in market history all felt terrible at the time. March 2009 felt like the end of capitalism. March 2020 felt like the world was ending. 1987, 2000, same thing. And every single time, the people who could bypass their fear and keep investing made fortunes, while the people who listened to their fear and sold locked in massive losses. This is the psychology bypass. It's understanding that your feelings about the market are usually wrong at extremes. When you feel amazing about stocks, they're probably expensive. When you feel terrible about stocks, they're probably cheap. So how do you actually do this? How do you bypass your psychology and invest when everything feels awful? 2 strategies. First, automate it. Set up automatic investments that happen regardless of how you feel. Your emotions can't sabotage you if the decision is already made. Second, reframe the pain. When you see your portfolio drop, don't think, "I'm losing money." Think, "Everything just went on sale and my next investment will buy more shares." It's the same event, but the framing completely changes your emotional response and your behavior. The fifth and final reason is something I call the survivor's advantage. This is about what happens after the crash, and it might be even more important than the crash itself. Here's what most people don't realize. The companies that survive a crash often come out stronger. The weak companies die, the strong companies survive, and the strongest companies actually gain market share. During the 2008 crash, thousands of banks failed, but the big banks that survived, they got bigger. They bought up their failed competitors. They consolidated the industry. They came out stronger than before. During the 2000 dot-com crash, hundreds of internet companies went bankrupt, but Amazon survived, Google survived, and they dominated the internet for the next 2 decades. Every crash is a stress test. It reveals which companies are actually strong and which were just coasting on good market conditions. When you invest in a broad index fund during a crash, you're buying the whole market, which includes all these survivors, all these companies that are going to emerge stronger. And here's the kicker. After a crash, there's usually a period of explosive growth. The weak are gone, the strong are hungry, the economy starts recovering, and the surviving companies grow faster than they did before the crash. The companies in your portfolio aren't just returning to their previous levels, they're often growing beyond them because they're leaner, stronger, and facing less competition. This is the survivor's advantage. By investing during a crash, you're not just buying the recovery, you're buying the supercharged growth that often follows. Look at what happened after 2008. The bull market that followed lasted over a decade. It was one of the longest and strongest in history. The companies that survived became juggernauts. Or look at 2020. The COVID crash was followed by an incredibly strong recovery. The companies that adapted became more valuable than ever. This pattern repeats every cycle: crash, survival, recovery, explosive growth, and the people who invested during the crash get to ride the entire wave. Now, here's where things get really interesting, and this might make some people uncomfortable. Everything I just described isn't theoretical, it's not wishful thinking. It's how wealth has been created for over 100 years of market history. But here's what nobody wants to admit. Most people will never do this. Most people will panic and sell during the next crash, just like they did during the last crash and the crash before that. Why? Because knowing what to do and actually doing it are completely different things. When the market is crashing, you're not just fighting your emotions. You're fighting your family's emotions, your friends' emotions, the news media screaming that everything is falling apart, your coworkers talking about their losses. You're surrounded by panic. And staying calm in the middle of panic is one of the hardest things humans can do. It goes against every evolutionary instinct we have. When everyone is running from danger, your brain wants you to run too. That instinct kept our ancestors alive, but it destroys investment returns. Here's the brutal truth. The reason market crashes create wealth for some people is precisely because most people can't handle them. If everyone could stay calm and keep investing, there would be no crash. Prices wouldn't drop. The opportunity exists because of the fear, and the fear is real. It's not irrational. It's deeply human. This is why financial education isn't enough. You can know all the data, know all the history, know that crashes are buying opportunities, and still panic when your portfolio drops 30% in 2 weeks. Knowledge doesn't override emotion when the stakes feel this high. You need something more. You need a system. You need automation. You need to make decisions before the crash happens. Because in the moment of a crash, you will not be rational. Nobody is. The people who succeed aren't more rational. They're just better prepared. They set up their automatic investments before the crash. They wrote down their plan before the crash. They committed to their strategy before their emotions got involved. And then when the crash comes, they don't have to be brave. They don't have to be smart. They just have to stick to the plan they made when they were thinking clearly. This is the real secret. It's not about being fearless during a crash. It's about removing the need to be fearless by automating the decision before your fear shows up. Let me tell you about David. David started investing in 2006. He was 28 years old. He had a good job, started putting $500 a month into a retirement account. For 2 years, David watched his account grow. By late 2007, he had about $15,000 invested. He felt like a genius. The market kept going up. His balance kept growing. Then 2008 happened. The financial crisis hit. David watched his $15,000 drop to $10,000, then $9,000, then $8,000. Every single day, he'd log into his account and see red numbers. Every day felt worse than the last. The news was terrifying. People were comparing it to the Great Depression. His parents told him to pull his money out before he lost everything. In March 2009, David couldn't take it anymore. He had about $7,000 left. He sold everything, moved it to cash. He told himself he'd get back in when things stabilized. By the time things felt safe again, the market had already recovered 30%. David waited even longer. Eventually, he got back in around 2012. By then, the market had more than doubled from the bottom. Today, David is still investing. He's doing fine. But here's what he doesn't realize. That decision to sell in March 2009 cost him hundreds of thousands of dollars in future wealth. If he had just held on, kept investing his $500 a month through the crash, his portfolio would be worth about $200,000 more than it is today. $200,000 gone, not because the market failed him, because he failed to understand the opportunity. Now, let me tell you about Lisa. Lisa also started investing in 2006, same age as David, same $500 a month. Lisa also watched the 2008 crash happen. She saw her portfolio drop. She felt the same fear David felt. She heard the same scary news. But Lisa did something different. Before she started investing, she read about market history. She knew crashes happened. She knew they were temporary. She knew the market always recovered eventually. So when 2008 hit, Lisa made a decision. She didn't sell. In fact, she increased her investment to $750 a month. She figured if stocks were on sale, she should buy more, not less. Was she scared? Absolutely. Did she doubt herself? Every single day. But she trusted the data more than her emotions. From March 2009 to the end of 2010, Lisa invested while the market was still low. She accumulated shares at prices she'd never see again. Fast forward to today, Lisa's portfolio worth about $450,000. David's portfolio from the earlier story, about $250,000. Same starting point, same monthly contribution for most of the time. $100,000 difference because Lisa invested through the crash and David sold. But here's what's really interesting. Lisa doesn't feel like she did anything special. She doesn't feel like a genius or a hero. She just followed a simple rule. Keep investing. Don't check the account too often. Trust the long-term data. That's it. No special knowledge, no complex strategy, just the discipline to keep doing the boring thing when everyone else was panicking. David tells people he got unlucky with his timing. Lisa doesn't talk about it much, but the numbers tell a very different story. Here's what most people don't realize about investing in market crashes, and this might completely change how you think about risk. It's not actually about predicting the market. It's not about timing the bottom. It's not even about being brave during a crash. It's about understanding that volatility and risk aren't the same thing. The market going down isn't the risk. You panicking and selling is the risk. Think about it. If you invest in solid companies or broad index funds and hold for decades, temporary crashes are just noise. They're just volatility. Annoying, scary, uncomfortable noise. But if you sell during a crash, you transform that noise into permanent loss. You take temporary volatility and make it permanent damage. The risk isn't the crash. The risk is your response to the crash. This is the reframe that changes everything. Most people think investing is risky because markets crash. But that's backwards. Markets crashing is how investing creates wealth. It's the feature, not the bug. The crashes are what create the discounts. The discounts are what create the outsized returns. The outsized returns are what create wealth. Without crashes, everyone would get average returns. The opportunity exists because most people can't handle the temporary pain. So when you hear that investing is risky, that's not quite right. Investing is volatile, and that volatility is uncomfortable. But if you can handle the discomfort without panicking, the volatility becomes opportunity. The difference wasn't about David being unlucky and Lisa being lucky. It was about understanding what risk actually meant. David thought the crash was the risk, so he sold. Lisa understood her emotions were the risk, so she stayed invested. Same information, completely different frameworks, completely different results. And here's what might blow your mind. The next crash will feel exactly like the last crash. Scary, uncertain, like the end of the world. And just like the last crash, it will be an opportunity disguised as a catastrophe. The question is whether you'll recognize it this time. So let's recap why investing during crashes can make you rich. The discount window. You're buying the same assets at 30 to 50% off, accelerating your wealth building by years or decades. The compounding accelerator. Those extra shares you accumulate at low prices compound for decades, potentially becoming 30 to 40% of your portfolio. The transfer mechanism. Wealth doesn't disappear during crashes. It just moves from people who panic to people who stay calm. The psychology bypass. Your fear is usually inversely correlated with opportunity. The worse you feel, the better the buying opportunity. And the survivor's advantage. The companies that survive crashes often emerge stronger and grow faster than before. These aren't theories. These aren't wishful thinking. These are patterns that have repeated through every market cycle for over 100 years. The people who built wealth in the market didn't avoid crashes. They embraced them, not because they were braver or smarter, but because they understood that temporary pain creates permanent opportunity. And here's the empowering part. You can do this too. You don't need to be wealthy. You don't need to be a financial genius. You just need to set up automatic investments and stick to them through the scary times. That's it. That's the whole strategy. Invest consistently. Don't stop during crashes. Wait decades. Get rich. The hard part isn't understanding it. The hard part is doing it when your portfolio is dropping and everyone around you is panicking. But here's what I want you to remember. The next crash is coming. We don't know when. We don't know what will cause it. But it's coming. That's how markets work. When it happens, you'll have a choice. Join the majority and panic, or join the minority and invest. One group will look back with regret. The other will look back at it as the best financial decision they ever made. Which group do you want to be in when the next crash happens?